I do want to ask you, though, you've been defensive historically, even when the market was soaring, and it does sound like even at this level, you're more in line with what Warren Buffett said on Saturday than some sort of bullish stance.
Yeah, sorry, Carl. Yes, I am. This market rally is nice to see, but the bull market's over, and we're in a bear market, and I think we're in a trading range. It's nice to see some of the other stocks do better today, but this market's been highly concentrated in 5 names, the stay-at-home names, and we're far from out of the woods on this one.
There's been the Goldman this week, for example, took a crack at the concentration you're talking about of the tech giants and how much they account for the S&P highest level in 30 years. Their point is that those types of concentrations always resolve the same way, and their argument is that they're unable in the long term to provide the earnings power to maintain positive sentiment for the index overall. Do you think we're going to retrench because of that?
Carl, I do. June Kim, our global equity director, did some homework, and those 5 stocks represent 20% of the S&P. They represent 7% of the overall Russell 3000 index, so over 17% of the U.S. stock market. And as is pointed out, historically, that's not a good concentration, and it's not that the other boats rise up to their level. They usually decline down, and these are the stay-at-home stocks, so they're priced to perfection. You've been talking all morning. The next step is to move out and for people to be out in society. Not that these stocks are going to crumble, but they need to fade away, and we need to see the rest of the market have some strength. We're going to be in a bear market territory in a trading range probably for easily a good 9 months. I don't think we're going to see a return of a bull market anytime soon.
Hey, Chris, good morning. It's John Fort. I see you say you expect us to be trading in a wide range through the summer and into the November election. It certainly doesn't sound like you expect that wide range to be higher from here. So do you expect major averages to go lower than they did in March? And if you think that's possible, how do you weight that possibility?
I don't, Jonathan, see them going back to the March 23 lows. I just think that we're going to be in a range, probably 2950 on the S&P on the high side. So we're close to that. We hit it last week, and maybe 2350 or 2400 on the low side. Even though we're opening up the economy slowly, you're still only talking about people picking up merchandise at the front. You're talking about restaurants being at 50% of capacity. I know I don't enjoy wearing a mask, walking around outside or going to the store. Having to wear a mask in California into work even all day is just not going to be something people are comfortable. I know my staff and many people I talk to would rather stay at home. They don't mind driving up and picking up some merchandise, but they're not eager to go shopping in this kind of an environment. So we still have a long way to go, especially if we have a resurgence in the fall. People are going to want to shelter in place on their own, even if they're not ordered to. Maybe not the whole economy. Clearly, we have some people that want to be out and about with a virus out there, but there are a lot of people, especially I listened to Scott Gottlieb last night, and I get worried. The side effects, the impacts of this virus are serious.
Yeah.
And while there's a desire to be out, and I think that we're going to see some downward pressure on this market. The optimism right now is great, but we'll see some downward pressure on this market probably again in the fall with all the uncertainty.
Chris, at the same time, it seems like there's a growing disconnect between the health outcomes and data that we're seeing and the economic moves that we're seeing at the same time. Even though deaths continue to rise in some locations, there's economic opening up. And so I wonder, should investors really be watching the health outcomes, or should they be watching the economic moves? Because it seems that for better or for worse, and we don't know which yet, certain areas of the country seem to be willing to risk the health outcomes in order to drive the economic ones.
I've been talking to my board this week, and that's the question I'm getting from them. It looks like this market is divorced from reality. There is such a strong bid to this market, particularly overnight trading in the futures overseas. And I just can't, it doesn't make any sense to me. So yes, I'm going to say I agree with Warren Buffett. There's a big risk. I agree with the genius. But it really seems surprising that there's such a strong bid into this market, and we're trading up in these higher part of the range. when you're right. The reality is this is still a serious virus. We're opening up, yet the number of deaths, the number of infections are really plateauing, not declining. Everybody is so excited that we bent the curve, but we haven't really seen it slim down on the downside. It's really just maintained. And I fear by opening back up that we're going to have more cases. This virus is so contagious. It sticks to different areas. So this is a health recession. This is not a financial recession. And we're not out of the health data. I think we have to pay attention to that to understand what is going to happen in the markets. And prices should reflect that uncertainty.